All right, what is up, traders? What's up, tycoons? I'm really excited to bring you today's video because we're going to go over how I do intermarket analysis. And if you missed the last video on my intermarket video analysis, we talked about the VIX, and everyone just now was speaking about the VIX and how it went up over 25%, and all of these different things. And yes, you can look at the VIX, right? The VIX is one way to do some market analysis. But there's many deeper ways, right? And a lot of these are institutional grade levels analysis that I'm going to provide you guys in today's video. And these are just things that I've learned over the years from other people and, looking at how some of these institutions really do their research. So it's going to be a really great video. It's going to be jam-packed with knowledge and great info. And I think you're really going to enjoy it. So we'll go ahead and start off with it, right? And let's start off talking about volatility. Now, on the top here, we've got the VVIX. Okay, so if you didn't know, there's a volatility of the volatility index. Okay, that's your VVIX. And I mentioned, hey, the VVIX, that's going to be the one that you really start to see kicking off, right? If you're worried about volatility, because we're mentioning how all of these were at support just a couple weeks ago, right? No, they're all at support here. The VIX and the VVIX are at support, and you're going to see the VVIX turn up first, right? And so the VVIX had a much stronger move, right? You can see by these two weekly candlesticks here. And the VIX saw a nice move here as well. And we were kind of expecting this, right? And it's very common, not all of the time, but it's very common for the VIX and the S&P 500, which is down here, your SPX S&P 500 index, to move in opposite directions, right? And this is something that we were preparing for, right? And really looking at, and haven't really been entering too many new longs in the past 2 3 weeks because we know that there are some risks. Right now, we are still in a bull market, so it doesn't make sense for me to, see some warning signs that we could see increased volatility and then start shorting everything because that can backfire on you, right? But rather, it's telling you, hey, maybe you want to be a little bit cautious right now. So this is a really good way to measure volatility is you actually want to look at the VVIX as well, because this is going to show you, how the VIX is going to turn out, right? You can see the VIX itself is still relatively trading sideways, and the VVIX had a much larger upturn here recently. Okay, so that's starting off with some volatility there. The other way that I really like to look at it is you can use the bond market, right? And I like to look at the bond market a lot, right? I trust the bond market a little bit more than I trust some of these other people. Now, you can look at tips in the NASDAQ. The tips oftentimes can be a leading indicator for the NASDAQ, Treasury inflation protected securities for tech stocks. And the way you want to use this here recently over the past few years is whenever these have a divergence, meaning that they're moving in opposite directions, oftentimes the tips can be a leading indicator, right? And so I've highlighted all the divergences and highlighted in yellow, what the NASDAQ should be doing based upon what the tips are doing. You see the tips is making this long downtrend here of lower highs. Meanwhile, the NASDAQ is making higher highs, and it's suggesting that the NASDAQ should have some type of a pullback. And it really forecasted the potential pullback that we saw last summer before we bottomed in October, right? And what do we have here? Well, we have a large uptrend here in the NASDAQ, and the tips is making lower highs, all right, and is going down. So this is one of those things that was suggesting, hey, we could potentially see a rollover in the NASDAQ and could be due for a pullback, right? So we're looking at volatility, saying, hey, volatility might spike here. There's reasons for volatility to spike. We're looking at the tips and NASDAQ measurement, and we're saying, hey, well, there's potential reasons for the NASDAQ to pull back right here. If we stick on the bond market here and we take a look at TLT versus the S&P 500, this also can be a leading indicator, right? And what are we seeing here? Well, we see there's these divergent periods where TLT is making lower highs, but the S&P is making higher highs, suggesting that, the stock market should pull back. We see that happen. And where are we at right now? Well, we're again at this divergent period where TLT has been making lower highs and lower lows, but the stock market has been doing the exact opposite. And what do we see? We see that the stock market has started to roll over, making a low and now a lower low. We take a look. There's other ways to measure this too, right? You can look at the advanced decline line. Okay, so this is like the NYSE advanced decline line, the stocks advancing versus declining. All right, and the bond market can also be used as a signal for this here as well. And again, what are we seeing? we see we have these divergent periods here, right? And it suggests, if you follow what the bond market is telling you, it suggests these periods here where we could start to see things roll over. And that's exactly what we're seeing here. We're starting to see highs, lows, lower lows. So it doesn't necessarily always mean that we're about to see some big impending crash or some huge doom in the market. But rather, as I mentioned, it's telling us, hey, maybe there's some reasons to be cautious, right? So we're looking at volatility, we're looking at the bond market for insight using intermarket analysis. And then there's a couple different things too, right? These right here are what I like to call the four pillars of the market. This is going to be tech and semiconductors. Okay. We all know how heavily weighted tech is, and semiconductors are basically the transports. They're the modern day transports. So the Dow Jones Transportation Index used to be extremely important. It still is important. But if you think of technology as the number one commodity and resource, rather, well, what transports technology, right? What gets it from point A to point B? It's semiconductors, right? It's the chips that are powering those. Then you've got industrials and the home builders. And, initially for the stock market to potentially make new all-time highs, we were looking at these and saying, hey, all of these are stuck above and, below overhead supply. And we're waiting for all of them to break out. All four of the four pillars were making a giant cup and handle. This was leading us to be very bullish. And you can see that they all bottomed here in October of last year and have gone on a very strong run, right? So, if you want to see a bullish or a bearish environment, these four pillars are going to be pretty crucial to understanding market context. And at the moment, it appears that a lot of them are trying to top out and putting in a nice rounded top. So we'll have to see if this develops and how this develops, right? Does this mean that a stock market crash is imminent? No, as long as these are above previous cycle highs, we're still in a bull market, okay? So that's the four pillars, okay? You can take a look at those. All right. There's some other measurements here too to measure like breadth, market breadth. And so what we're looking at here is going to be, we're going to be taking a look at the percentage of stocks above their 50-day moving average and their 200-day moving average. So we'll zoom in on this a little bit to make things a little bit cleaner for you guys. Okay. Just give me 1 second and we'll get through and things will be nice and clean here. Okay. All right. And so there's these periods here again where we see divergences also. All right. Specifically, you see we're making higher highs here and lower highs. This is the number of stocks above their percentage of stocks above their 200-day moving average. Once it gets, to above 80%, it's very frothy in the market. Okay. And, when you get above 50%, this basically is a signal that, hey, the overall market is bullish, right? Over half of stocks in the market are above their 200-day moving average, and the 200-day moving average is used as a long-term signal a lot of times for a large number of stocks and institutions and things like that. And you can see once we got above there, that's really, we got above it right around here. We moved sideways, and then that's when we really exploded and started making new all-time highs. And this is the percentage of stocks above their 50-day moving average, okay? And in here, you want to use it kind of the same way. Once this starts getting to about, 87 or higher percent, oftentimes that can be a little bit of a topping signal, right? Not necessarily a forever top, but a little bit of a short-term top, right? When you have 90% of stocks trading above their 50-day moving average, maybe things are a little bit too hot in the market. And we've been seeing these and we've been noticing that we've been having some divergences. A lot of these previous divergences have worked out pretty well, also as some good sorry about that, a little hiccup, as some good signals into where are potential bottoms, where are potential tops. This is October bottom right here. We see the S&P 500 continuing to make new lows right here, but the percentage of stocks above their 50-day moving average, this is the October timeline here, was making a low and a higher low. So that was a bullish divergence. And it was also in this period here where only 6% of stocks were trading above their 50-day moving average. I mean, that's extreme bearishness, right? Just like up here when 90-something percent, 93, 94% of stocks are trading above their 50-day moving average, that's extreme bullishness, right? And oftentimes, these big extremes tend to put in short-term bottoms and short-term tops. So those are some things that you can look at and pay attention to. I also like to look at the skew index, okay? And so mostly for buy signals, I've highlighted all of the times that the skew has come down to this zone here. It's basically, below 115, have been relatively good buy signals. That's this green zone here, and I've marked all of those arrows. I've marked arrows down here on the S&P 500 where all of those times have occurred. But the yellow lines here, these are often where things are getting maybe just a little bit too frothy in the market. Okay, and we could potentially see those stock markets start to move sideways or start to pull back a little bit. And again, we're up here in these frothy levels, and we have started to see a little bit of a pullback in the skew index, right? There's seasonality too. Different ways to take a look at seasonality. We'll just use this one right here. In seasonality, it's not something necessarily to live or die by, but it's something that you guys can use. You see, we pretty much, in this time period here up until June, we kind of move sideways, right? And then in the summer, that's when we really start to kick off here seasonally, right? Is later in the summer. So we'll see how that plays out. Then you can, take a look at some measurements such as the RSP, right? This is going to be your equal weight index for the S&P 500. Okay, and what do we see here, right? So this is a ratio chart. So the RSP relative to the S&P 500. So your equal weight relative to the S&P 500. And we see here that we were looking and we were saying, hey, well, it looked like this could be a potential oops here. And rather, we've actually started to see this roll back over, right? And one thing that people don't realize is, when the equal weight is outperforming the weighted cap index, that's not necessarily bullish, right? I mean, this is an extremely bullish time period here, 2023. And take a look at this. The RSP is massively underperforming the market weighted, the equal weighted is massively underperforming. So, if you're bullish on the market overall, you want to see this performing and heading in a downtrend, basically. Okay. Now, let's keep going, okay? Because there's lots of measurements, lots of ways that you can look at things, right? This is another one here that I like to look at. This is going to be, we have the equal weight versus the S&P 500, right? We talked about that one, RSP versus SPY. We have small caps versus large caps. This is IWM versus IWB. And then we've got industrials versus tech, XLI versus XLK. So we see here that really, since the beginning of the year in 2024, industrials have actually been outperforming tech, right? And we see that small caps were trying to outperform, but they're on the verge of retesting their, the lows relative to the large caps, right? So, they did bottom in November of 2023, right around October lows because, the stock market bottomed in late October and small caps versus large caps bottomed, but it really peaked in the beginning of the year. And in 2024, small caps have been underperforming relative to large caps. And then also here in the beginning of the year, we saw that equal weight was outperforming the S&P 500, ever since the early beginning of the year here, right? And you can start to put a lot of these things together and look at all of these things, and it gives you ideas of, hey, when are times to be cautious in the market? What are some of the sectors? What are some of the areas that I want to be paying attention to in the market, right? If you're looking at this industrials versus tech chart, you're saying, okay, well, hey, maybe I want to be looking at more industrial, stocks relative to tech stocks because those have been outperforming tech, this year, and perhaps that could be something that continues for the rest of the year. There's also ways to measure risk on versus risk off. Okay, so I've actually created a risk on ETF here, and then I have a risk off ETF here. If you didn't know, many platforms give you the capabilities to make your own, ETFs in a sense. Thinkorswim does it. I know TradingView does it, and you basically just combine ticker symbols together, and it will, combine the performance of all of those together. So we've got a risk on ETF here, composed of copper, high yield bonds, the Aussie dollar, semiconductors, and high beta stocks. And then we've got a risk off ETF here, which is gold, US Treasury bonds, the yen, utilities, and staples. We can see this thing broke out massively here, right? Meanwhile, the risk on ETF, has actually begun a downtrend, right? We have a high, we have a lower high, we have lower highs here. So, the risk on ETF is telling us relative to the risk off ETF that, hey, the market is more risk off here, right? And that's been evident over the last month. Since the beginning of March, we've seen that the risk off ETF has broken out. Meanwhile, this peaked in March. Okay. If we move on, you can take a look at the put call ratios. Oftentimes people like to use these as contrarian indicators. And so, red up here is bearish. Okay. This is when there is a abnormally bearish amount of bets, via the put to call ratio. And then green is bullish. And if you were to use those as contrarian indicators, so basically once the put to call ratio comes into the green zone here, maybe it's, if you're a contrarian, you're saying, hey, things are a little bit too bullish, we could pull back. And if it comes into the red zone, hey, maybe we're a little bit too bearish, maybe we could rise a little bit. I've marked all of these signals here. And, sometimes it works, sometimes it doesn't, but it gives you a good idea of sentiment, right? So this is another thing you can pay attention to and really just add to your intermarket analysis and market breadth, market measurements. Another one is going to be, you want to pay attention to oil. Okay. Oftentimes the stock market and oil move in opposite directions as evident by this chart. And we're at this period here where we were seeing oil rally since November, and we're seeing the stock market rally since November. And the big question here was the reason that we have this highlighted and circled right here is, what is oil going to do, right? Is oil going to continue breaking out past this key zone here? If it does, then that could potentially lead the stock market to roll over, right? Because it's not very common that you're going to see them move in the same direction for extended periods of times. As evident by that chart right there, you can clearly see that. There's other things too. There is the McClellan Summation Index. There's a McClellan Oscillator. You can look at those individually. You can look at them combined. Same concepts. We're seeing some divergences here. Okay. We're seeing that, when the stock market is going up and the summation index is making lower highs, and the McClellan Oscillator is making lower highs, that has led to sell-offs previously in the market. And again, we're at this period here where we're making lower highs and we're making lower highs, and the stock market was making higher highs. So again, another thing telling us, hey, maybe we want to be a little bit cautious right now. Okay. It's common to see these divergences. They don't play out immediately. As you can see, they're often go through extended periods of times. But they're things you want to be aware of, right? Things you want to pay attention to, and to help, come up with your thesis of the market and potential market direction and what plays you want to be paying attention to, and getting into. All right, then we've got a ratio chart here of the mags versus, this is the Magnificent 7 ETF, essentially right here. All right, and, I like to look at this one because the mags, as I mentioned, it's going to be your Magnificent 7 ETF. All right. And to me, it's pretty important to pay attention to this one, because, the narrative in 2023 was that it's only 7 stocks, right? There's only 7 stocks, really pushing the market, really driving the market. And so we've got a ratio chart here of the Magnificent 7 ETF versus the S&P 500. Okay, so when this is going up, it means the Mag 7 is outperforming the S&P 500. As we just saw, we were starting to see a lot of stocks rolling over here recently via the broad market index, the SPX. We've started to see a pullback, but when you take a look at the ratio chart here, the Magnificent 7 stocks have been and continue to outperform the market as a whole, right? This goes back to the beginning of the year of 2024 right now. And we've got a strong uptrend right here, right? The last time we highlighted this, we were saying, hey, this is going to be yet again another test of this trend line. Is this trend line going to break here, or are we going to bounce? And we got a very strong bounce on this chart here. So, this is another measurement that I like to use. You can also take a look at the Magnificent 7 stocks versus the equal weight S&P, which is the RSP. You can take a look at their year-to-date changes, month-to-date, week-to-date changes. And the RSP actually has been outperforming over the past month and the past week. Okay, so it's different than the SPY, than the S&P 500 itself, right? The week-to-date change for the Magnificent 7 was 0.43%. Meanwhile, on the RSP, it was up 1.86%. On the month to date, it was up 3.32%. And on the month to date for the Magnificent 7 stocks, it was only up 0.79%. We can see on the year though, year to date, it's up about 21%, the Magnificent Seven, and year to date, the equal weight S&P 500 is up about 7%. All right, now let's move forward. Let's talk about some other things here. Um, there's other markets, okay, that you can also play. And so what we're actually highlighting here is going to be the dollar versus gold. Okay. And specifically, we have an inverted dollar index here. Okay. So what this means is that the green line is the inverted Dixie, DXY. So when the inverted Dixie is going down, it actually means that the US dollar is going up. Okay. And, these move very, very similarly. All right, if you take a look at these, when the inverted Dixie is going down, meaning the dollar is going up, you see that gold futures are going down. So they move opposite of each other. And you can see that this stays, pretty consistent. But here we've got this big divergence that's occurring now at the moment, where they're moving opposite of each other. So we're seeing the inverted dollar go down, which means that the dollar itself is going up. And then we're seeing gold go up at the same time. So one of these is lying. Okay, essentially is all of that means is one of these is doing a head fake because it's not common and it's not standard for the dollar and gold to move up at the same time or move down at the same time. They typically have an inverse relationship, as you can see by looking at the inverted dollar versus gold futures. They move together invertedly, right? They have an inverse relationship with each other. Now, there's many inverse relationships in the market. If you take a look at the inverse 10-year versus the S&P 500, so this is your inverse 10-year treasury yield, essentially that we're going to be looking at right now. We're going to come back to those. I have no idea why, but this screen, the inverse 10-year versus S&P is just frozen for some reason. But all of the other ones are working here. So the next one we're going to take a look at is going to be credit spreads. Now, credit spreads are something that I'm relatively new about, that I've been paying attention to for maybe the past 6 to 12 months. But Michael Batnick from the Compound, he says, hey, if you could only have one type of indicator, like only one thing to look at, right? So whether it's an RSI, whether it's the McClellan's, whether it's some of these other intermarket relationships, what is it that you think would be the best, for the economy and spotting potential recessions or yada, 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 if we're in a strong economy? He said credit spreads. And so I really like that. And so I started diving into different credit spread measurements. So what we've got is a ratio chart here of the IEF versus the LQD. And typically, you just want these to move in the same direction. Now, when I say these, I mean, you want to see this credit spread ratio, move, or I'm sorry, in the opposite direction of the S&P 500. And this lets you know that, hey, the moves that we're seeing are justified right now in the market. Okay, you can see this ratio chart is making lower lows while the S&P is making higher lows. It's making higher highs while the S&P is making lower highs. And right now we're still on a downtrend here. Okay, we've been making lower highs, we're making lower lows, all right, and the S&P has been making higher highs this entire time. Now, it hasn't been as aggressive, right? The downtrend here hasn't been as aggressive as the uptrend has been, but we're still seeing healthiness, right? So what we really want to pay attention to is this credit spread ratio potentially going to start breaking out? Because that's going to justify further downside in the stock market, right? If we take a look at, the HYG versus the SPX, it can kind of going by, letting the bond market tell you, and letting the bond market speak to you. Oftentimes, that's referred to as smart money, the high yield ETF. And then dumb money, would be, the stock market. Okay. And what do we see? Well, the smart money here was making lower highs, right? And turning down. And we actually just made new lows, right, for the year. Meanwhile, dumb money was continuing to head higher. We were seeing this divergent period, and it was a signal that, hey, potentially smart money is telling us and warning us that we could be due for a downturn. Now, as I mentioned, a lot of these divergences take time to play out. They're not going to play out immediately. So just because you immediately spot one, it's been divergent for the entire year, right? So for a full quarter, it's been divergent. So it's not telling you, hey, time to short everything. If you would have been shorting everything the whole year, you'd be down right now. Okay, you'd be down on your position because we're only a few percent, maybe 2-3% off of the top of the highs here in the S&P 500. So again, these are just things that you want to look at in the market, let the market speak to you, but you have to know where to look and where to listen for what the market is speaking to you, about. And these are some of the areas where I like to look. Now, you can look at high yield versus, US Treasuries. All right, again, this is going to be a measurement of credit spreads here. And once again, you typically are going to see these, moving in kind of opposite directions. Well, rather, whenever you see these moving in opposite directions, that's going to be a signal, right? So it's kind of like the TLT and the tips, the smart money versus dumb money. You're going to see these different relationships here. And, what do we see here in the beginning, right? Well, we see our credit spread ratio chart here making lower lows. Meanwhile, the S&P is making higher lows. This suggests that, the stock market could be due for a pullback, right? And we take a look over here, well, we see our credit spread ratio is actually making higher highs. Meanwhile, the stock market is actually making lower highs. This is suggesting that, hey, we're actually supposed to start making some higher highs. And sure enough, that's what we end up doing. Right now, they're pretty much trading very similarly, right? So we're not seeing a huge divergence here or any major divergent signals. They've been tracking relatively similar. We are starting to see a slight uptick in our credit spread ratio monitor here. So if this breaks out to make new highs and the S&P 500 is continuing to make new lows and continuing in a downtrend, well, that could be a signal that, hey, maybe this is a false move and this is a divergent move in the S&P 500. And just like over here in the past, when this was making higher highs and this was making lower highs, we could be actually due for higher highs, later forward in the future. Okay. Let's take a look at some more things right here. This is growth versus value. I really like this one a lot. Now, this had a massive breakout here recently over the past week. This is let me move my head out the way for you guys. This is going to be your S&P 500 growth versus value. So this is via SPY-G ETF, the SPY S&P 500 growth ETF and the S&P 500 value ETF. And then we've got the Russell 2000 growth ETF IWO divided by the Russell 2000 value ETF IWN. We see this rolling over here, right? Making lower highs. We see this rolling over here, making lower highs. Meanwhile, the stock market was continuing to make higher highs in this period, kind of just giving us a signal that, hey, potentially we could be due for a pullback here, right? And what do we see now? Well, we see the SPY in the S&P 500, we're actually seeing growth break out. Okay, the reason that these charts are important is because in a bull market, you're going to see these outperforming, okay? And you're going to see this chart going up, these ratio charts going up. You're going to see growth outperforming in bullish cycles and in bullish environments relative to value. Okay. Now, what does this mean for us currently? Well, we want to see, is this a false breakout here? Is this a false move? Are we going to start seeing some participation from perhaps the small cap growth versus value? And could this be a sign that this pullback potentially is ready for a move to the upside and potentially ready to break out? That's something that we want to pay attention to and be looking at, right? We're seeing that we had multiple signals saying we were due for a pullback. A lot of them we went over in the beginning of the video. And then as we're progressing through here, we're starting to get a couple signs that, hey, maybe it's time for us to start getting a little bit of a bounce potentially in the future, right? We're seeing a breakout here. We just took a look at that credit spread measurement. And we saw that that's actually starting to tick up a little bit. If that continues to tick up and make a higher high, that could potentially lead to higher highs in the stock market, right? Let's move on and let's talk about some more things here. We can always talk about the yield curve. All right. The yield curve. What we've got is the yield curve on top. We've got Fed funds futures in purple here, and then we've got the S&P 500 down here. I've marked all of the time. So, people always talk about when is the Fed going to cut rates. If you look at data and just let the data speak for you, it's when the yield curve gets uninverted, right? The yield curve gets uninverted here. The yield curve gets uninverted here. Yield curve gets uninverted here. Are we uninverted? No, we're actually getting more inverted, right? It actually just started ticking down. After these periods, this is when you can see, all right, once we uninvert, yield curve, the Fed funds rate starts going down. Once we uninvert, Fed funds rate starts going down. We uninvert here, Fed funds rate starts going down. we're not at this period here. So, I'm not expecting in any rate cuts anytime soon, just because of where the yield curve is right now, right? It's still uninverted. And once we get up towards zero and we get out of inversion, then I anticipate Fed rate cuts to be happening, slightly before or slightly after, once the yield curve is not inverted anymore. And that has led to recessions many times. Okay. Everybody knows about the yield curve as a recession indicator. It's not going to happen until the Fed potentially starts cutting rates. If it does start cutting rates, and the yield curve historically needs to, uninvert for that to happen. So, from my perspective, if there is going to be a recession, it's not coming very soon right now. And I know that the closer that the yield curve is to uninverting, then the closer the potential for a recession is, right? If we take a look at some more things, 52-week highs versus lows is something I like to look at. Again, you can spot these divergent periods where, the highs versus lows, is making a low and a lower low here, all right? And then we're making higher lows here, just suggesting that we could be due for some pullback. And then what do? We actually do get some pullback. That's actually when we bottomed. Afterwards is after we got that signal and you saw a huge uptick in this, right? Here are some other examples of divergences where, the 52-week highs versus lows is making higher lows here. Meanwhile, the stock market's making lower lows. That was a divergent buy signal, and you see we started an uptrend there. Same thing happened over here, higher lows, making lower lows, divergent buy signal. You see we start to make an uptrend there afterwards. And then here, we have this period where we're continuing to make lower lows. We're continuing to make higher lows here, signal that, hey, we could be due for a pullback. And sure enough, we do end up getting that pullback there. There's some more things. Beta rotation is another one. And you can kind of just, come in here and look at where the rotation is in the market from a beta standpoint. We won't dive too far into it and into this indicator, but what are we seeing here? Well, we're seeing energy, staples, cyclicals, industrials, materials, you know, basically a lot of defensive things, okay, are uptaking here, right? Cyclicals are seeing flows in, and look what's seeing flows out is technology, right? Technology is actually seeing flows out, right? That's what the red line is, heading towards the bottom here as money flows out, heading towards the top here as money flows in. And this is, a little bit of a beta rotation, measurement script that we've got here. We can take a look at, defensive. This is how I kind of measure if the market is defensive versus offensive. And so we've got some ratio charts here relative to the S&P 500. So we've got the S&P on top, all right? And we've got high beta versus low volatility stocks. When this is performing up, that's typically a bullish market environment, okay? You can see when the stock market is in a downtrend here, high beta stocks are not outperforming low volatility stocks. Same thing here with the discretionary versus staples, right? We're seeing a divergence here. So, the S&P 500 throughout this time period is continuing to make new all-time highs. We're not making any new highs in the high beta versus low volatility stocks. We're not making any new highs in discretionary versus staples either. Typically, you're going to see this in an uptrend when, the market is in an uptrend here as well. This is a divergence. This is a negative divergence here. This is a credit spread measurement right here. This is, we mentioned credit spreads. This is another credit spread measurement right here. And it's tracking more closely to the S&P 500, but we're not seeing very aggressive highs being made here. We're kind of just making equal highs while the S&P is making higher highs. And then we've got biotech, okay? And, biotech, in my opinion, is one of the arguably the most risk-on asset classes. And the reason being is because if you think about what you're investing in with biotech, you're investing in unprofitable companies, right? You're investing in companies that are most likely burning through large amounts of cash, oftentimes have to dilute shareholders or take out loans and things like that to fund their research and development, ultimately in hopes of having a successful patent product or some type of thing that eventually will, spin the company into massive profits and get them into profitability. But until then, until they have that, they spend tons of money on research, right? And so we're seeing basically all of these divergences here, right? And letting us know that, hey, even though we've been going up, when you look underneath the surface, the market has been a lot more defensive than it seems, right? We're not seeing biotech, making new highs. We're not seeing credit spreads really, keeping up with the pace of the S&P 500. Discretionary versus staples have a bearish divergence. High beta versus low volatility has not been making new highs like the S&P 500. And so it lets us know, throughout this time period here, hey, things are a little bit more defensive than they seem. And, a lot of people don't realize, I've highlighted it before in some previous videos, but energy was the top performing sector of the year so far in 2024. You wouldn't have realized that if you weren't paying attention to energy and you were just looking at the S&P 500. You wouldn't have realized that energy was outperforming tech, right? And outperforming every other sector in the market, literally. Um, so yeah, you start to find these things whenever you start looking beneath the surface like this and taking a look at all of these. The Dow Transportation Theory is pretty important. We kind of touched on it briefly when we were going over the four pillars, but oftentimes it's a leading indicator, okay? Oftentimes it will top before the stock market and bottom before the stock market does. And there's also divergent periods, right? And so we see here the Dow Jones Transportations, it actually topped before the previous all-time high in the Dow Jones Industrials and the S&P 500. And then it also bottomed, right? The transports bottomed before the S&P 500 bottomed, right? So again, it can be a little bit of a leading indicator here. And what do we see? Well, we see all three of these broke out around the same time. That was a very good signal for the stock market, for the S&P 500, that this is a healthy breakout and going to continue to the upside. And what are we seeing now? We're seeing that, just like some of the other measurements we looked at, this thing has been moving sideways, right? So meanwhile, while industrials and the S&P are making new all-time highs, the transports have been moving sideways, right? And we really wanted to see some follow through and see them break out to new all-time highs, but it's moved sideways. And if this continues to roll over, it could be more of a signal that, this bearish divergence could be a signal of what's to come, just like how it topped out previously before the rest of the stock market has. We can move on and take a look at the dollar versus the S&P 500. Oftentimes, these have an inverse relationship here, as well as evidenced by this chart. But here recently, we've been seeing them move in the same direction for the past 4 months. And what's really interesting is what happened the last time that they were moved in the same direction, specifically up. Well, we had a 4-month divergence where the dollar and the stock market were going up, and it led to a rug pull, right? Quote unquote rug pull, not some crazy massive 50% drop like a crypto rug pull or anything like that, but it ended up leading to a very significant pullback and really was a signal of the bear market of 2022 if you were paying attention to it, right? And what do we have right now? We've got yet again another 4-month divergence, right? For the entire year of 2024, the stock market and the dollar were both rising, making higher lows and higher highs. And, the last time we put it out, we said, hey, is this a potential rug pull coming, right? And since then, we've actually started to see the stock market roll over here a little bit. We take a look at some other things here. We've got, the EPR model, economic cycle, the business cycle. I just dropped videos on those. For people that are really big fans of like looking at the equal weight versus, the market cap weighted, the equal weighted NASDAQ has not made new all-time highs yet. If you take a look at the equal weight S&P 500, I believe that one's been performing a little bit better. That one was actually able to make new all-time highs here. So, I'm liking what I see in the market, right? And I like using all of these different measurements and really just using all of this stuff as a way to look underneath the hood of the market. Sometimes, as I call it, is, get in underneath the hood, really see what's going on with the engine of the stock market. Because if you're just looking at one thing, it may be a little bit hard to tell what's really going on. And as I mentioned, if you're just looking at the S&P or something like that, you really wouldn't have known that energy was the top performing sector, right? But if you start seeing how high beta stocks are performing relative to low volatility, you start looking at many of the different measurements that we have going on, it gives you a little bit insight, and then it tells you what areas you really want to start paying attention to, what areas potentially you want to start avoiding. And hopefully you guys enjoyed today's video, okay? I'm trying to bring you guys stuff that other people really aren't bringing you, and, just put you on how institutional, basically some institutional grade analysis, right? I'm not saying, I'm better than these institutions, but rather, hey, these are some of the things that I picked up, from research, from, reading, the stuff that these institutions put out, figuring out why they like these things, what are they used for, researching them myself, and then learning how I can use them to potentially give me an edge in the market and let me know where I should be paying attention to and what I should potentially be cautious of. So that's going to wrap up today's video. Smash that like button and subscribe to the channel for more.